Hi, good evening. Welcome to our presentation on the budget. It was quite an interesting day, and there are already reactions coming from the markets and from variety of sources. We are here to talk about some of the key tax and regulatory proposals that have been enunciated in this budget. With that, if we could get into the next slide, please. So I, along with my fellow partners, will be taking you through a variety of changes. I'm here to give you the opening context. So next slide, please. So as we look into, what is the context of this announcement, and a lot of this was also covered in the economic survey. I mean, we obviously have this completely unprecedented times, once in a century pandemic, which also set the context of what was said to be once in a century a budget. We obviously are dealing with the risk to economy, health, and lives. There is, global economy is expected to be contracted. Unfortunate loss of lives, loss of jobs. So it is in perhaps one of the most difficult times in which a budget of this kind is being presented. At the same time, as compared to the rest of the world, India has had it kind of better. And while there is recovery expected around the world, India is certainly looking to optimize even in these dark times. And I think the budget is setting the context of that as well. Next slide, please. Again, economic survey, if you have gone through it, has set out some of these contexts as it matters to the state of economy. There was a record contraction of roughly 25% in Q1, but there is a certain amount of recovery. That recovery is likely to continue, and even as per IMF, the real GDP growth is likely to be 11% in the coming year. Obviously, that is on a smaller base, but it is still a remarkable recovery if nothing else goes wrong, and we continue down the path we are. I think it will be a phenomenal turnaround. Of course, there is inflation to be looked at. That has to be kept in mind. Fiscal deficit, it's a no-brainer. Fiscal deficit will not be as per the norms, and we saw the budget also moving a proposal to amend the FRBM Act, and everybody believes that that is the right thing to be done. In fact, that has been the expectation from this budget, that this is the time to spend and on infrastructure and variety of things to kickstart the economy, kickstart the demand. Of course, India is the only emerging markets to be in FI inflow positive in 2020. That again is a good news. So in that backdrop, it sets the context of what announcements we heard. A lot of policy changes, interesting policy announcements were made in this budget. And next slide, please. So of the key announcements, and of course, me and my colleagues will take you through that, but we continue down this path of faceless assessments. We saw that being announced in the income tax. We saw that that is being announced in the customs in the recent past. And now even for income tax appellate tribunal, this scheme has been announced. So it continues down the digital push in all procedures involving taxpayers meeting with the tax department. We of course saw the insurance limits, FDI limits being increased from 49 to 74% in the insurance sector, and Sunil will cover that in his presentation. This LIC IPO is something that has been talked about, but there's something more formal in the speech this time. The interesting aspect of one-person company may be allowed to be incorporated. We need to see all the details around it, but again, something very interesting as a larger policy announcement. We saw the effort of decriminalizing the Companies Act, but I think need of the hour is also to look at the limited liability partnerships on similar lines, and it is good to see that that announcement has been made. Of course, consolidation, refreshing of, we saw the launch of labor codes along the same lines. Securities market code is being talked about, and again, Sunil will talk about it in his presentation. This whole aspect of voluntary vehicle scrapping policy, 15 years and 20 years, certainly step in the right direction. Obviously, in the coming days and months, there will be debate whether 20 years is a good time, or should it be 15, should it be longer? But at least it's a good start in a direction which has been expected for a long time. What personally excites me the most is this whole mechanism for dispute resolution. While it has been talked about in the context of smaller taxpayers, but I'm sure if that pilot is successful, it will set the base for even larger companies and larger disputes. But something which is a very important start. And of course, finding a section of taxpayers, the senior citizens with only pension or interest income who don't even need to file return, again, is a step in the right direction. Obviously, as more and more will get experimented in this area, the opportunity to expand this will increase. Next slide, please. So with that, if I may invite my partner Sunil to take you through the direct tax proposals and all the several key regulatory changes that have been announced. Sunil, over to you.
Well, by the time we could have Sunil connected, I would please request Vivek Gupta to continue with the slides.
Thank you. And let's go up a couple of slides, just one slide down. Okay, so this has been a very interesting budget, I think, from an investment, M&A, and deals perspective. And let me talk about it in the next 10 or 15 minutes. I think the key thing that the government has done, and the most pleasant change that we have seen, is that actually there has been no fundamental amendment in the tax regime in terms of rates or in terms of any other basic change. And how the government has looked at the revenue side is that it has tried to come up with a regime where it has enabled the investment flows into the country. So the first thing is InvIT and REIT-related cash flows have been significantly smoothened by abolition of the dividend tax withholding regime, which I think is a very fundamental change from the perspective that dividend tax withholding was simply a cash flow trap when the SPV distributed the dividend to the InvIT or the REIT. Similarly, for foreign portfolio investors, tax withholding on dividends has actually been aligned now to the real tax position. We had a section 196 where dividends on FPIs used to attract tax at 20%. And now that regime has been changed to say that the actual treaty rates applicable in respect of those dividends would apply. One of the most significant tax changes that we've seen is the entire regime on goodwill depreciation has been completely overhauled. Up until now, we had a judgment of 2012 from the Supreme Court, which recognized that goodwill is an asset that is capable of depreciation. So the fundamental change that has been made is that the goodwill is no longer a recognized depreciable assets. And this impacts IRRs of even concluded deals. So for example, if I bought an asset last year, I envisaged that there was goodwill that would be generated on purchase of the asset. Tax law permitted me to depreciate that goodwill, and I factored that into my purchase price. From now on, as a result of this change, goodwill will no longer be eligible to be claimed as depreciation, and therefore the IRR of my deal is significantly impacted. In the context of mergers, perhaps this is correct, because mergers are meant to be a tax neutral transaction, and therefore there should be no step up in tax basis, and therefore there should be no resultant additional depreciation on goodwill that should arise, notwithstanding the Supreme Court judgment. However, the budget change also makes a similar change in respect of acquired goodwill, which means if I buy a business on a slump purchase basis where the seller pays all tax, unlike a merger where the seller is not paying tax, the step up in tax basis, which would otherwise be available to me, is still not available. The memorandum very interestingly states that even acquired goodwill in a slump purchase transaction will not be eligible for depreciation since goodwill is an asset which is not fundamentally depreciable but subject only to impairment. The memorandum also has very interesting wording to suggest that while the government recognizes the Smith's judgment, it still says that the mode of computation of depreciation on goodwill will follow provisions like Section 32, provisions like explanation to section 43, and therefore it has cast doubt on even past depreciation claims on merger goodwill. So if I were to sort of summarize the impact of these amendments, any deal by way of slump purchase, any acquired goodwill, there will be no depreciation claim that is available going forward. Any goodwill that has arisen on merger where a past depreciation has been claimed, I think the memorandum casts enough doubt for the tax authorities to raise a litigation in respect of that claim. Any depreciation claim on goodwill on a slump purchase basis in the past is effectively grandfathered, and that goodwill will still continue to be eligible for depreciation for the past periods. Going forward, however, i.e. from the next assessment year, that goodwill will not be eligible for depreciation. What the government has instead clarified is that cost of acquisition will be stepped up on a non-depreciable basis. What that, this was actually obvious. What that effectively means is that all assets or all goodwill acquired through a slump purchase will be eligible as a offset when the undertaking is sold in turn. So from a goodwill perspective, I think significant impact has been made, and this is effectively retrospective because it impacts IRRs of even concluded deals. The next interesting question that arises is what happens in respect of treatment of other intangibles? What the government has done is it has retained the language in section 32 on other intangibles. So trademarks, know-how, and all such other similar intangibles will continue to be eligible for depreciation. So in a slump purchase transaction, all of those intangibles will be fully eligible for depreciation. In a merger transaction, however, due to the observations in the memorandum, which cast doubts on past depreciation claims, these other intangibles may not be available, depreciation may not be available in respect of these other intangibles. The direct impact that we see on this is in the context of controlled deals. We have seen in the past 2 or 3 years, a number of controlled deals happening in the economy, either through mergers or through slump purchases. I think all of those deals will be significantly impacted in the context of this change. Can we go one slide down, please? Thank you. The next level of change is in the entire slump sale regime. So there was a judgment in the past which was used to effectively claim no taxation positions in respect of slump exchanges. Slump exchange effectively meant a transaction where there was a non-monetary consideration passed, and because the definition of slump sale used the words transfer by way of sale, courts had interpreted that slump exchange transactions could not be brought to tax. The government has very correctly amended the provision to say that it is the intent of law that all sorts of slump sale transactions, whether for monetary or for non-monetary consideration, should be fully taxed. So effectively, this is like plugging a loophole where non-monetary transactions were being used to avoid taxation in respect of business transfer transactions. The next change in respect of partnership restructuring regime is also a very interesting one. We have seen many instances where capital has been withdrawn by partners on dissolution on a tax-free basis. Over a period of time, what was starting to happen was that partnership capitals were created for a larger amount through the recognition of goodwill. A change in law has now clarified that any goodwill created on a self-created basis, merely by passing entries in the books of account without actually purchasing that goodwill, would not be eligible for this benefit. So effectively, the dissolution of partnership firms, restructuring of partnership firms by withdrawal of capital, etc., will now be impacted as a result of this change. I look at this change also as plugging a loophole, because it was clear that the partner was in fact deriving income higher than his cost base, and therefore this loophole needed to be plugged. The next interesting change where I think deal activity will be significantly impacted is the potential change in look-back period. Till now, the law provides for a 6-year look-back period for past tax liabilities. That look-back period has now been changed from 6 to 3 years. So ordinarily, one would have expected that deal indemnity negotiations will be impacted favorably, where the buyer effectively needs to claim indemnity from the seller for a period of 3 plus 1 years. However, this comes with another change which says that if there is any concealment of income where the tax impact exceeds a certain threshold, the look-back period can be seen to be expanded to 10 years. So while on the basic one hand, the 6-year period has come down to 3 years, and that would have a favorable impact, one would need to see how that concealment of tax is defined, and therefore in what circumstances that 10-year look-back period will come into being. Another interesting change is the insertion of the words liable to tax in section 2, and this would impact private equity funds, this would impact sellers of transactions. This change has been made in section 2, subsection 29A, and in terms of interaction with the treaty, the issue that would need to be seen is whether the introduction of the words liable to tax means that a fund or a seller who's, let's say, selling from Singapore or selling from Mauritius and is claiming a treaty exemption position would also need to show that he is at the basic root liable to tax for that income in his home country. The jury is still out on this one. We need to walk through the fine print to see this, but early indications suggest that the insertion of the words liable to tax could give the tax authorities that handle, where if an exemption is available to the seller in a foreign jurisdiction, the treaty exemption under India could be potentially challenged. Two other changes in accordance with the basic theme that I had stressed at the beginning. I think the government is looking at transactions happening in the banking and financial services sector. The government is also looking at putting in place regimes for acquiring stressed business assets. And therefore, two changes made there. Conversion of urban cooperative banks into banking companies have been accorded tax neutral treatment akin to a merger. Likewise, AIFs will be permitted, and this is what the finance minister indicated in her speech. AIFs will be permitted to acquire stressed business assets. Up until now, you needed the ARC structure to do some of those deals, but apparently now a legislative regime will come into place where AIFs could potentially do the same. I would like to go 2 slides up actually, and then I will come to some misses. So I would like to go 2 slides up pretty quickly, and then I can come to some misses in the context of the M&A deals and investments environment. So if we see in terms of basic themes, I think the government is looking to attract new classes of capital. They've come up with a strong asset monetization program of public operating infrastructure assets. Power Grid and National Highways Authority will be the initial sponsors of these InvITs, and we will look at something like 12,000 crores of initial value coming into these assets. We have now a regime where FPI debt will be permitted into private and public REITs and InvITs. Tax concessions available to infrastructure companies in respect of zero coupon bonds will now be extended to infra debt funds as well. And the government has promised to set up a new DFI to achieve debt funding for infra projects. The government has laid out a very audacious target of 5 lakh crores in 3 years, starting with an immediate allocation from the current budget of 20,000 crores. So I think this is a very fundamental change that the budget has talked about, how to attract classes of capital which were hitherto not available, how to put in place monetization mechanisms of public operating infrastructure assets which were hitherto just simply owned by the government, but not monetized for the larger good. In keeping with this theme, and this is what has allowed the government perhaps to keep its tax laws mostly unchanged. There's a strong push for a realistic PSU disinvestment program. The government has talked about, the government has talked about strategic control transactions in 2 banks and 1 insurance company. The government has a 1,75,000 crore budget target for this. In the context of the current global capital environment, perhaps this is something which is very, very achievable, especially in respect of the quality of assets that have for the first time been put under this PSU disinvestment program. In order to further enhance the IRR for these PSU disinvestment programs to actually work, the government has amended provisions relating to demerger as well as loss carry forward provisions. Effectively, what one can expect is that for all PSU disinvestments, the acquirers will be able to get the benefit of demerger taxation, so tax neutrality. The acquirers will be able to claim the benefit of past tax loss carry forwards, which would otherwise have been impacted had these legislative changes not been made. From a governmental standpoint, this means larger value coming to it in terms of receipts under the disinvestment program. Further impetus to funds activity has been provided. My colleague Sunil will cover this in greater length. In the IFSC, more tax exemptions have been put forth, and we will talk about this at greater length later in the presentation. Likewise, in insurance, control FDI is now possible. 49% has been opened up to 74%, subject to the fact that Indian nationals are those who control the insurance company. This again will be a very positive development. If I can now request me to take me to the last slide. So go 3 slides down, please. Yes. So in terms of misses, I think 4 quick misses I will talk about. These were expectations that we thought the government will fulfill, largely in terms of being able to channelize global capital market flows into Indian businesses. So overseas listing, cross-border mergers, and forward mergers for SPAC transactions. These 3 transactions, or these 3 changes were meant to be able to attract foreign capital into Indian businesses. Indian businesses, we were expecting, will be allowed to list overseas with a very stable and sublime tax regime. Cross-border mergers, we were expecting tax neutrality to be accorded to them. And for SPAC transactions, we were expecting that forward mergers of companies holding Indian assets into SPACs will be permitted. This would have perhaps opened up something like 15 to 20,000 crores of capital flows in the next 12 to 18 months into Indian businesses. These have not been done. Perhaps the intent is to carry out some of these changes separately, because the government had noted as far back as May 2020 that it intends to make these changes. The other miss that I would talk about from an M&A standpoint is there is a bunch of deemed income provisions under Section 56, which are meant to catch a certain category of transactions. It does seem that they cover within their ambit even genuine M&A transactions involving, for example, distressed companies, transactions involving listed companies, transactions involving trades between third parties where actually there is no intent to cause any gifting to happen. We were expecting certain rationalizations to these deemed income provisions, but we haven't seen those. So in a summary, from an M&A deals and investment standpoint, I would say a huge investment push from the government on REITs, InvITs, and the infrastructure side. Some rationalization on goodwill in the context of merger that would have been acceptable. In the context of slump sale, I think it's a big hit. In the context of retrospectivity of application, I think it's a big hit. And number 3, a bunch of other changes, largely around how to attract more capital into the country. With that, I will turn it over to Sunil, who I hope is now connected, and who can turn back to the corporate income tax and financial services sector changes. Thank you.
Okay, thank you, Vivek, and sorry for the technical hitch. So good evening, everybody. From a corporate tax and from an FS perspective, I think I would say largely the budget has been quite encouraging and quite positive, because we've seen new taxes, including the COVID cess that was being talked about. And obviously people had a lot of fear around some of these aspects, but I think that's very clear now that we are not going to see any new taxes. The changes are there, but they're very minimum, and some of the changes are really welcoming. So with that, if we can just go to the next slide. So I think Rajiv spoke about the whole dispute resolution scheme, and we've seen number of changes coming in that space. So first of all, as you all know, like faceless assessment and faceless appeal, we now are going to see a faceless ITAT scheme, which has been introduced. So going forward, even the appeals with the ITAT will actually go into a faceless regime, only in certain cases where, if the members want to actually hear the cases face to face, then the video conferencing will be allowed. We will have to wait and watch what kind of guidelines and what kind of framework is going to get announced. But again, this is one of the good step in the right direction. The whole regime around authority for advanced ruling is going to undergo change. As we know that the AAR was introduced with a great intent to give certainty to the taxpayers, but practically we've seen number of challenges, and the biggest one was actually the delay in the disposal of the rulings. So that whole regime is going to now change. It's going to now be a board of advanced rulings, so BAR. And what's going to happen is that instead of a retired judge of the Supreme Court, the board of advanced ruling will be handled by two chief commissioners, and the order of the BAR will be actually appealable directly to the High Court. So this is one way of expediting your disputes straight to the High Court. If, let's say, the verdict of BAR is against the taxpayer. Also, all the applications which are pending at the specified date, which obviously will be announced in due course, all the pending applications of before AR will now move to BAR. The settlement commission, which is in place today, that's going to be discontinued, and an interim board will be constituted to look into the pending cases. I think a need was felt that maybe because of the whole new scheme and the changes that have been announced, you probably don't need the settlement scheme, and therefore that is going to be discontinued. The other change, which actually is clarificatory in nature, is going to have a limited application, which is that the current VSP scheme which is going on, the cases which have been decided by the Income Tax Settlement Commission will not be eligible for VSP. So with that, if we can move to the next slide. Okay. The another important change in the context of corporate tax or direct tax, which has come about, is the whole regime of income escaping assessment. And I think Vivek did touch upon in the context of M&A and deals. So as he mentioned, that the whole regime of income escaping assessment is now undergoing change. We had a period of 4 or 6 years, and in most of the cases it was 6 years, because the threshold which was applicable for 6 years was quite low. So effectively, you had a situation where your assessments could have been reopened up to 6 years from the end of the assessment year. That tenure is going to get reduced to 3 years. As Vivek mentioned, in certain specific cases where the income likely to escape the assessment is in excess of 50 lakh rupees, the time period of 3 years can get extended to 10 years. However, these will be very specific cases. Now, as you all have heard, the finance minister in her speech mentioned that it will be only those cases where there will be significant tax evasion. However, in the fine print, we just read as specific cases, and it's a matter of interpretation. All it says is that it should be a case which gives rise to an asset in excess of 50 lakh rupees, whether recorded in the books of account or outside the books of accounts. So prima facie, it seems that even the cases which are not directly covered by the tax evasion can get covered under the extended tenure of 10 years. But again, we'll have to wait and watch as to how this whole thing pans out. The other significant change which has come is that in the existing regime, the assessing officer has to actually just issue a notice to the taxpayer, and he doesn't necessarily have to give reasons for reopening the assessment. However, a new section 148A is proposed to be introduced, and the assessing officer will have to give opportunity of being heard to the taxpayers and give reasons as to why he wants to reopen the assessment. So actually, what it will do now is it will give taxpayers a clear sense of what issues are going to be there under the reassessment, and also he or she will get an opportunity of being heard. If we can move to the next slide, please. Next slide. Yeah. So there are certain significant changes which have been announced on TDS related matters. As you know that currently there are provisions which actually require sellers to collect TCS when they sell goods to the buyers, and also there are provisions which require the payer of certain specific payments to actually deduct TDS. Under the new regime which is proposed, if as a buyer your gross turnover or receipt exceeds 10 crores in any previous year, you will be liable for the new regime of the TDS. And if you buy any goods in excess of 50 lakh rupees, you will have to deduct a TDS of 0.1% on the payment that you make to the seller. So let's say if I am in the business of selling computers, relating to that, any raw materials that I buy, today I do not deduct any tax at source. Going forward, if I am going to buy any material in excess of 50 lakh rupees, I will be obliged to deduct a TDS of 0.1% on the amount that I pay to the seller. As I mentioned, I will be liable to deduct TDS only if my turnover or receipt is in excess of 10 crores. They've also clarified that if there are transactions which are subject to specific TDS regime which is currently in place, or if there are transactions which are where TCS is applicable, then the new regime will not be applicable. Also, there are provisions proposed which require the buyer to actually deduct TDS at a much higher rate of twice the rate applicable or 5%, whichever is higher, if the seller does not have a permanent account number, PAN number, or if the seller is an entity which has not filed the returns for 2 previous years. Now, of course, this kind of raises a question as to what happens to a newly incorporated company, because they would not have completed 2 years of filing the returns. So whether the applicable rate of TDS will be 5% or 0.1%, based on the plain language of the provisions, it seems like a higher rate of TDS will apply. There is a very welcome change which has been introduced, which is that like you have capital gains, because you cannot estimate when do you earn capital gains, and therefore if you pay the advance tax after the capital gains have been accrued to you, and if you pay the advance tax before 31st March, there is no interest under section 234C applicable. The representations were made in the context of dividend income as well, because you as investor do not know when and how much dividend a company will declare, and therefore there's no way you can actually estimate how much will be your advance tax liability on account of dividend. So now they have included dividend income also at par with the capital gains, to say that if you earn dividend income after the declaration of the dividend, if you have paid the relevant amount of advance tax on the dividend income on or before 31st March, or on the applicable due date of the installments of payment of advance tax, then interest under section 234C will not be applicable. The threshold exemption available for tax audit has been increased from 5 crores to 10 crores for those entities which have at least 95% of the transactions in the digital mode. So which means so long as your cash transaction does not exceed 5%, the increased limit of tax audit of 10 crores will apply. Next slide, please. Okay, so there are a couple of compliance related changes which have been announced. The first one is the scope of 143A, where the assessing officer has powers to make prima facie adjustments, that has been expanded to cover even those items which have been added in the tax audit report, but the assessee has not included in the return. The due date for issuance of intimation has been reduced from 12 months to 9 months from the end of the financial year in which the return was furnished. The due date for issuing scrutiny notice under section 143(2) has been reduced to 3 months from the end of the financial year, and the filing of belated return and the revised return deadline also has come down to 3 months from the from the end of the relevant assessment year. So I think those are the some compliance related changes which have been announced in the budget. Then I think without getting into too much of details, there is there are certain powers given to assessing officer for provisional attachments of the taxpayer's property in excess of amounts of 2 lakh rupees of penalty. Also, I think the board can now come up with certain conditions for relaxation of treating the returns as defective tax return in the case of certain taxpayers. Next slides, please. Okay, again, these are some miscellaneous changes under section 56 to 10 and 43 CEA, where there was a difference between the valuation that was declared by the taxpayer and what valuation that has been determined by the department's valuer. That has been extended from 10% to 20%. So which means that if the difference between the two valuation is to the extent of 20%, then there is no adjustment possible. So again, this is a good change. The tax holiday period for the startup has been extended from March 21 to March 22. So as per the existing provision, the startups have to be incorporated on or before 31 March 21. Now that has been extended to 31st March 22. The adjustment on account of minimum alternative tax has been relaxed in the context of APA, where let's say a secondary adjustment has been granted, and therefore tax officer has to make that secondary adjustment. Now that adjustment will not form part of calculation of the book profit for determining applicability of minimum alternative tax. Similarly, for FPIs and some of the other foreign companies which do not have any place of business in India, there was no MAT applicable on certain incomes like capital gains, royalties, etc. Now that dividend income is also taxable in the hands of these foreign investors, so the dividend income also has been included, and therefore, if there is a dividend income, it will be outside the purview of book profit to be calculated under minimum alternate tax. There is a small amendment under section 36(1)(5)(a), which says that if the employer, after deducting the contribution on account of PF, does not pay the contribution within the specified date provided under section 43B, then that deduction will not be allowed to the employer. The term liable to tax has been redefined, and it includes also those cases where an initial, so long as the foreign company is liable to tax, but subject to any exemptions. If you can move to the next slide, please. Okay, these are some regulatory announcements. I think Rajiv has already touched upon the insurance FDI limit has been increased from 49 to 74%. Permanent institutional framework will be developed to take care of the bond markets, which is again a long-standing demand. DFI will be set up on the lines of IDFC to actually mobilize the funds and extend the long-term finance. Also, there are a number of securities regulations today like SEBI, Depository Acts, SCRA, etc. They will all get merged into one single securities market code, which is going to be announced. I think Vivek has already touched upon InvIT, REITs, and FPI investments therein. Also, I think Vivek has again touched upon the FPIs being given relaxation on account of TDS. Now they can actually avail of the treaty benefits even at the time of TDS. The NBFCs, which were eligible to go into the SARFAESI in cases where the loan amount was in excess of 50 lakh rupees, that limit has now been reduced to 20 lakhs. Also, the public sector banks recapitalization will be, there will be additional recapitalization of 20,000 crores. Again, we have to wait for some more details and guidelines around that. I think Vivek has already touched upon the tax neutral inclusion of UCV into banks, so I'm not going to talk about that. Then I think there will be a world-class, financial technical hub in the GIFT City. The detailed guidelines are awaited on that. So if you can move to the next slide, where I'll just quickly touch upon some of the financial service related amendments which have been proposed in the budget. Can we move to the next slide? Okay, so there is a relaxation for the sovereign wealth, welfare funds and the pension funds. Under the existing regime, if SWF and the pension funds directly invest into the infrastructure companies or infrastructure projects, they are eligible for exemptions on account of dividend, interest and capital gains. Now this exemption will be available to SWFs and pension funds even if they were to invest into, let's say, a holding company in India, which in turn invests into the infrastructure projects, so long as this holding company is registered on or after 1 April 2021. And the only condition is that the minimum investment of the holding company has to be at least 75% in the infra companies. Similarly, the SWFs and pension funds can invest directly into the NBFCs, so long as NBFCs invest at least 90% of the funds in the infra entities. Likewise, if the SWFs and pension funds were to invest in AIF, they will again be eligible for this exemption, so long as CATE 1 and CATE 2 AIF were to invest at least 50% of their investments in the eligible infra companies. There will obviously be certain conditions. And one of the welcome change which has been proposed is that there was a doubt as to whether if SWF and pension fund is in the commercial activity, then whether they are eligible for exemption or not. Now that has been removed. So again, that's a welcome change. If we can move to the next slide, please. So there is an additional impetus to IFSC. I think Vivek briefly touched upon. There are some 2 or 3 major changes which I'll quickly explain. One is, the whole regime of, fund managers in India. So if let's say the foreign fund managers were to be based in India, they can go to the CBDT and ask for exemptions from creating a permanent establishment in India, subject to certain conditions. There is further relaxation to those fund managers who want to move their base from their home country to IFSC. The conditions will be further relaxed. However, we need to wait for the notification in this regard to see as to what kind of relaxations are coming. Likewise, there was a doubt as to whether if a foreign company or foreign bank which have set up their branches in IFSC, and if they were to undertake any investment activities, because those investment activities can give rise to capital gains and therefore may not be eligible for tax exemption under Section 80LA, and hence whether those capital gains will be exempt or not, it has been clarified in this budget to say that even those capital gains will be subject to exemption under IFSC. Likewise, if a non-resident were to actually undertake any non-deliverable forward contract or cover with a unit in IFSC, they will not be subject to any tax on the income earned by them. On aircraft leasing, there was a representation made again by IFSC saying that we want to create an aircraft leasing market in IFSC, and therefore the exemptions have been granted to a foreign lessor who actually gives aircraft on lease to a unit set up in IFSC, where the lease rentals by the unit in IFSC to the foreign lessors will not be subject to any tax. And likewise, if the foreign lessor were to transfer those aircrafts, there'll be no capital gains tax on that. Similarly, if the unit in IFSC were to transfer the aircraft or aircraft engine, there'll be no capital gains tax on that. There are some AIF related changes in the, for those AIFs which have been set up in IFSC. if, let's say, an overseas AIF, I mean, let us say if there's an AIF in Mauritius, if that AIF wants to move to IFSC, there'll be no tax on the transfer of their holdings from Mauritius fund to the fund which is set up in IFSC. Likewise, if the unit holders were to exchange their units from Mauritius fund to the unit in the IFSC, there'll be no capital gains tax on the unit holders. And similarly, if the Mauritius fund was subject to a grandfathering regulations for the investments acquired before April 2017, then that will continue in the hands of the units which has been set up in the IFSC. So those are the welcome changes in the context of IFSC. I think with that, I will conclude my presentation on corporate tax and financial service. I now hand it over to Parizad Sarwala to take you through the personal tax changes. Parizad, over to you.
Thank you, Sunil, and good evening, everyone. Last year had its share of personal tax changes in budget 2020 that came about. Fortunately, this year there has been tax stability, and the current budget has actually retained the existing tax slabs and rates. So no change to the tax rates, no change to the tax slabs. The much talked about COVID cess did not see the light of the day. However, as they say, the devil is in the details. So there are certain provisions which, as we decode them further, could possibly lead to an increased tax outgo. One welcome change is around the rules to be notified for mitigation of double taxation. Now, you do have cases of NRI who have overseas retirement fund accounts opened in their respective countries, and they then they are residents of that country. But obviously, in the year when they become ordinary residents of India, there was a mismatch around the taxation of certain income accruals to those accounts. You know, one country taxes it only on receipt and withdrawal, and the other country could possibly tax it on accrual. Therefore, what the finance minister has proposed in her speech is that the rules will be notified to mitigate this anomalies around timing mismatches and taxation mismatches around overseas specified retirement funds. Well, it's not known at this stage what kind of retirement funds are we talking about in the context of US citizens. Is it a 401k contribution? We'll have to wait and watch. Now, during the pandemic, it was obvious that people could not travel, and therefore the LTC commonly used exemption was not really being availed of. In any case, in October 2020, there was an official memo prescribing that if you would spend particular expenses which were GST leviable at the rate of 12%, then you could get exemptions for your leave travel concessions. This is just now notified and brought about by way of a change in the law itself. As I said, some of the fine prints could possibly land up increasing the tax rates for certain categories of individuals. ULIP, which is a very popular investment cum insurance linked product, and there have been a lot of discussions and deliberations around the tax implications of ULIP products. Well, as you know, as per the existing provisions, the amount that you receive on maturity of a ULIP policy is currently exempt from tax, provided the premium to capital sum ratio did not exceed 10%. Through budget 2021, it is clarified, and apparently the intention seems to be to provide benefit to only small and genuine cases of people who purchase life insurance policies, and not really to high net worth individuals again who want to claim tax exemptions by investing huge amounts in ULIP. That's again the stated intention in the speech, as the Honorable Finance Minister has pointed out. Therefore, again, high net worth individuals, which always seem to be a popular category of taxpayers, seeing increase in their tax outgo, it has been clarified that for any ULIP policy that you take after 1st February 2021, where the premium payable now exceeds an amount of 2.5 lakhs per annum, is going to be taxable in your hands, though on that it will continue to be exempt. So these ULIPs are now going to be classified as capital asset on redemption. The tax treatment is proposed to be brought on par with equity-oriented mutual funds, and therefore the tax rates, depending on the period of holding, would be either short-term, long-term, 15, 10%, as the case may be. The manner of computation of tax capital gains will be specified. Interestingly, the retiral amounts for people have been touched even last year. As an example, you will recollect that last year, the finance minister in the budget 2020 introduced a tax on aggregate contributions made by the employer towards Provident Fund, NPS, and superannuation schemes in excess of 7.5 lakhs per annum was brought to tax, by last year's budget. This year, again, a very interesting change. Currently, the interest accrued or received on our public provident fund and provident fund is currently exempt from tax. Here again, if you read the fine print of the speech, the intention as stated is that some individuals are contributing huge amount to these funds and are claiming entire interest income as exempt. So it is again proposed to tax interest earned to the extent of contributions relating to 2.5 lakhs per annum as now taxable. 2.5 lakhs seems to be, a popular threshold which is being spoken about. This again, if you work out the maths, depending on your level of income and the structure, there could be certain higher tax outgoes. We've already covered the dividend income and the advance tax, but very welcome change. Last year, dividend income was taxable now in the hands of individual, with DDT being tax being scrapped. It is a much needed relief because as an individual taxpayer, it is impossible for me to estimate what amount of dividends are going to be received and quantified in my hands. So like you have for capital gains tax, only once a dividend is declared can you pay advance taxes on it. This will obviously obviate the need for any penal interest that's already been spoken about. Next slide, please. The rest is, largely procedural for extension of affordable housing, where stamp duty value of the house was within 45 lakhs. They've merely extended the benefit of 1,50,000 interest deduction by one more year. We've already spoken about, in light again of this pandemic, to help the real estate sector to boost the demand and to ensure that the unsold inventory can be liquidated. The safe harbor provisions, wherever the deviations between the stamp duty value and the actual sale consideration was more or less around 10%, they've hiked that up to 20%, of course subject to certain conditions, where the transfer of the residential unit needs to be within a prescribed time period. Senior citizens always had certain lot of wish lists from the budgets every year. Again, from a procedural and a compliance burden perspective, there is a relief provided for senior citizens above 75 years of age, for those earning only pension and interest income. If they were to declare this to the bank, the respective banks is just going to deduct the TDS, and there will be no need for these senior citizens to file return of income. Overall, in sum and substance, not too many changes from a personal income tax perspective, but I think the two key provisions in terms of tax outgo would be, one needs to really see the fine print around the ULIPs and the Provident Fund and PPF interest, taxability. With this, I'll now hand over back to Rajiv Dimri to conclude the session. Rajiv, over to you. Thank you.
I know we are slightly over time, but I'll quickly cover few of the important and significant indirect tax changes. One, of course, GST. So while we know that GST decision making is now with the GST Council, but there are two amendments proposed in the CGST and CGST law. One, which is a big relief to the taxpayers, where the current law required them to submit on a state-by-state basis audited reconciliation. That provision has been dropped. Going forward, the taxpayer on a state-by-state basis will only need to submit a self-certification reconciliation. So it will certainly save costs and time not to have your accounts re-audited at a state level. The second is has been an ongoing debate whether the entitlement to claim credit is dependent on your supplier uploading the returns and the invoices on the system, on the GST network. And this aspect has been now baked into the law, and therefore the position, at least in the law, is clear. Next slide, please. On customs, while we heard a lot of tariff changes in the speech, but beyond that, in the fine print, there were a couple of points that are proposed which are noteworthy. One, all customs notification that have any conditions attached, so any exemption notification with condition, will have a built-in sunset of 2 years from the date of issue. Within 2 years, whichever is the 31st of March coming up, they will expire, and therefore any long-term planning around customs exemption notification, particularly the ones that have some conditions attached to it, will have to be done very carefully because there's a built-in mechanism. All existing notifications, their start date is being seen as February 1, 2021, being today, and they will automatically expire unless they are specifically renewed on 31st of March 2023. So this does create an impact on any long-term business plans which are specifically based on customs exemption notification. We heard in the speech that there are over 400 existing notifications which are being reviewed, inputs are being sought, and changes will be notified by October 1st of this year. The third proposal is very, very interesting and welcome, that any investigation, whether from CSER or any other action, will have to be completed by law within 2 years. There is, of course, an option with the prior permission of the commissioner to be recorded in writing to extend it by a year, but certainly a time-bound mechanism has been built into the law. There are global customs and HSN classification that are to be changed from January 1 of 2022. On account of that, some 351 line items will get impacted. A lot of changes that have been put in terms of tariff have been put into place, but they will be effective as and when this date arrives. So it's an advanced planning, and it does allow the industry time to analyze it and plan their affairs. The next amendment is noteworthy. Along the lines of GSTN, the customs have a common portal, and posting a notice on the customs portal is being proposed as a sufficient discharge of serving of notice. So it does cast an onus on the taxpayers to keep updating themselves on what's in their account in the customs portal. Of course, emails do come in, but this is an onus being put on the taxpayer. And of course, we all heard about the Agriculture, Infrastructure and Development says, as far as customs is concerned, it's only on 25 notified products to be imported. So it has a limited application to that extent. Next slide, please. On equalization levy, it was expanded significantly last year. It came into effect from July 1, at least on the digital supplies. What has been clarified here is that equalization levy shall not apply if the consideration is chargeable to taxes, royalty, or fees for technical services. So to that extent, it has been clarified that the two taxes are mutually exclusive to the extent on royalties and technical services fee. The second is a more sort of expansive clarification, where the notion of online sale of goods or online provision of service, in a sense, has been clarified, that where any one of the following activities are being done online, it will be considered as an online sale of goods, whether it's an acceptance of offer, or placing or accepting a purchase order, payment, or supply of goods. Any of these activities will trigger the applicability of equalization levy. To that extent, the position that was being taken currently was, for it to be an online sale, the only event that mattered was the transfer of property. And to that extent, this clarification significantly expands transactions on which equalization levy would apply. And of course, they've also clarified that consideration will include value of goods or service, whether the e-commerce operator is selling those goods on his own account or facilitating it, and therefore, again, this expands the applicability of equalization levy. With that, I know we have exceeded the time, and I do apologize for the little technical glitch that we had, but I do hope that there are a few points that are going to be of interest to you. With that, on behalf of all my partners, let me thank you for attending our seminar. Have a good evening. Thank you.